This is Benzinga Live. Spencer Israel and producer AB.
What's up, everybody? How we doing?
Someone told me buy high, sell higher. So.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. What is up, everybody? Welcome back, Zinger Nation, to another episode of Benzinga Live. Happy Friday. We've got a pretty packed show today. Here in about 20 minutes, I'm going to be bringing on Sean Dekmar from... Sean Dekmar runs his own trading channel, and he's usually live trading throughout the week, but I think he takes Fridays off from trading, so we're lucky enough to have him on the show today at noon. We're going to hear about what he's been trading recently, kind of his setups and all the favorite stocks that he's been looking at the past few weeks and months, because it's been a while since we've had Sean on the show. And then 12:30... very interesting interview, especially today. Another Aaron is joining the show. Aaron Terrazas from Glassdoor. We're going to be talking about the labor market, different layoffs, different, what's going on. Because here's the thing, and we talked about this throughout the show this week, that you're seeing the big tech companies laying people off. News today of Google laying off, I think it was 11,000 employees. We're going to talk about that. We're going to talk about Microsoft layoffs. But at the end of the day, the jobs numbers that keep coming in on like the non-farms payrolls and the JOLTS data has all been good. And we looked at the unemployment numbers the other day, and they're the lowest they've been really since pre-COVID. And relative to the past 20 years, very, very, very low. So I think people see the headlines of, the biggest names laying people off and thinking, oh my God, like a lot of people are out there losing their jobs, but on an empirical data front, that hasn't really been the case. So here, let's go ahead and pull up Google stock here. I mean, Google's trading up now, more than 4% on the day that it announced layoffs. So, company said it will eliminate 12,000 jobs. Again, this is one of those things. Where notice when the tide kind of starts turning, right? The vibe shift, if you will, where now bad news, companies, stocks are now responding well to bad news, right? If Google announced 6 months ago that it was laying off 12,000 jobs, I think the stock's trading down. I think it's trading down significantly, probably by around the same amount, probably trading down by this, 4.3%. But now we're starting to see the stocks responding well to bad news. And I think Netflix too, I mean, the stock is trading really well. And I think the company had a good quarter and a better quarter than a lot of people expected. But I don't think necessarily, it was the blowout quarter that people are making it out to be. So paid memberships were up 4% year over year. That's big because I know the growth was in question. We talked a lot about it on the show yesterday. We looked at that app data. So, I don't know. I mean, I think before I, become more convicted, why don't you do trivia anymore? We could do some trivia today. Talking about job layoffs while the market's pulling back. Yeah, let's check out. I haven't even looked. I mean, I know SPY was trading higher before. Oh, I mean, we're not really pulling back that much. I mean, go to the 5-minute chart here. So yeah, we had a little, what is this, down? Oh, yeah, I mean, we had just hit new highs of the day, though, so pushed up above 392, came down a little bit. So we'll see. If we get back up to these highs on the show today, we'll see if we can make new highs. Otherwise, I mean, I think SPY is still trading pretty bullish today. And I like this pattern. I mean, this looks like a good, nice rounding bottom. If we were back on Get Technical, we'd talk about nice rounding bottoms that have a base. And you can kind of have really set price targets here. I mean, this first level of 394 and then all the way up to 400, which that 400 level, we're on a 5-minute chart here. We can go to a 10-minute chart. You can see how this 400 level, we hit multiple times and kind of rejected from there. So if you are swinging SPY to the upside, I would just be watching that $400 level and say, okay, if we can clear that, pretty bullish. If we can't, or if we hit 400 and looks like we're rejecting again, could be a lot of spikes for a rounding. Well, yeah, I mean, when we're really looking at rounding bottoms, we're typically, or at least on Get Technical, we were typically looking for stocks that had kind of consolidated and bottomed over a long period of time. This is on a 5-minute chart, so it's not going to be as nice of a rounding bottom as some of those other ones we were looking at. But my point still stands, essentially, that this is, you know, you can see kind of a base here, and now it's coming up. And I have been playing SPY to the upside on really any weakness. So made some money today on some calls, got out of some of them, and really just gonna go, you know, not really hold any short-term positions into the weekend. More art than science, right? Yeah, technical analysis, 100%. I mean, I don't think even the most technical, you know, chart person out there will tell you, like, oh, just because this chart's forming this pattern means 100% of the time it's going to do that, you know, whatever. And people might look at the same chart and see different things. I'm sure there are a lot of people out there that would look at this chart right here on the same time frame I am and would think this is very bearish. I don't know. I don't personally. And that's why I don't rely basically on technicals or on charts 100%. For short-term trades, I definitely weigh the technicals more than fundamentals or really news even. But I think you do have to take into account what's going on always on a macro standpoint, where money's cycling from certain sectors, and then decide, okay, is the chart setting up for this? Is that a pentagram donut? Oh, on his thing? Nice. JWN went green for a bit. That's Nordstrom, right? Let's check out Nordstrom. I haven't looked at really. I mean, a lot of these retailers have been getting absolutely. I mean, this is surprising to see Nordstrom all the way down at basically it's COVID lows. And I thought, I mean, I know, you know, so basically in terms of the apparel, how people are buying clothes, it's changing. I know people are shopping less at department stores and doing more online from, you know, I'm sure people are shopping more right now at things they find on Instagram, whether it's from, you know, things on there than going to Nordstrom for young people. But I mean, this is getting ridiculously cheap now. If we look at it from a fundamental standpoint, I mean, you've got a price to sales of 0.183, a forward PE of 7. I mean, it's almost as if like look, the market cap is 2.7 billion, but the company has, let's see, the company has $9 billion worth of assets and only about $3 billion worth of debt. It's almost as if the market's pricing in Nordstrom going out of business. I don't know. I mean, are all the retailers trading like this? Macy's pretty crushed too. No, let's check it out. Oh, that the sales were weaker year over year for holidays. Nordstrom shares are trading lower after the company reported a net sales decrease of 3.5% for the 9-week holiday period ending in December 31st, 2022. The company also cut its fiscal year EPS guidance. Yeah, I don't think anything, like, I don't think, you know, obviously it's all bad. I mean, I'm just saying from a pure fundamental value standpoint. Oh, Jay, I see what you're saying, that even Nordstrom turned green on this news, which could be like the signs of some tides shifting throughout the market. And yeah, I mean, that's if it, again, like, think about where we were in terms of the bear market 6, 7, 8 months ago or whatever. If I would have told you a company is cutting its fiscal year guidance and announced a weaker sales and in the same period year over year, and the stock is trading higher. Granted, it's not, you know, skyrocketing today. It's up 0.4%, but it's green. It's not down on this news. And again, I mean, the market cap of Nordstrom right now is less than $3 billion. Is this even right? Let's make sure this is right. JWN stocks. We'll go to Google too. Yeah, I mean, market cap 2.8 billion, and yet it like the company itself, like it seems like if it just liquidated all its assets would be worth double that. So I don't know. I mean, obviously something's going on there. Figure it out. But yeah, I mean, Nordstrom, Google, both trading higher off of what should be seen as probably like objectively bad news. I guess you could argue for Google that people might be thinking, okay, now the company is going to be cutting some cost. I mean, think about 11,000 jobs. You do some quick math. Assume everyone was getting paid $100,000 on average, probably more than that working at Google. That's a lot of money to be saving a year. So I don't know. I mean, that could be part of it for Google, but I mean, for Nordstrom, I mean, there's an argument there to be made that maybe people thought, assumed that period had been weaker and it was actually better than expected, and they assumed that Nordstrom would be cutting guidance. I don't really know. If anyone has any favorites in the retail space, like they like Macy's compared to Nordstrom, or they like Nordstrom's more than Ross Dress for Less, let me know, because I don't really have a lot of opinions on. Oh wait, this is a spec. What isn't Ross? I thought Ross Dress for Less was a stock. Yeah, it's ROST. Which, yeah, I was gonna say, it doesn't surprise me without even looking at it. I would have assumed that Ross's stock actually has been performing better than a Macy's or Nordstrom, because as we've been dealing with inflation and recession fears have increased. The names in competitor companies or competing companies, the ones that are a little bit cheaper, have been outperforming, right? Like Walmart's been outperforming Target. Yeah, man, Target's still getting crushed. So it doesn't surprise me to see that Ross has been trading a little bit better. Might be a little bit more defensive. Sorry, give me 1 second. Apple, however, I mean, you see Google trading up today. Let's go check out. I mean, Q's up over 1.5%, but Apple is basically flat on the day. And I wonder if Apple, I know, because other stocks, right? When you look at Netflix's chart, or you look at others like Meta's chart, stocks that have gotten crushed down to a point where you're not even really paying a premium, you're just paying for like a good value stock at that point. And that's where I think once Netflix got down to 167, people were like, all right, growth or no growth, like this company's worth holding at this price. And I don't know if we've ever gotten Apple knocked down to that. KSS was down in sympathy. Now green is my point. Yeah. Goldman Sachs being investigated by Fed. Stock taking a hit. We can look at Goldman Sachs too. Let's go to the news in here. But yeah, basically my point on Apple was just that Apple, I think probably because of its strength, like always has, people are still willing to pay a premium for it. So I'm not surprised to see other names start catching up, other names start, performing well, and still seeing Apple just kind of flat. Goldman Sachs consumer business faces Federal Reserve investigation. As it ramped up consumer lending. I wonder if this has to do with, because I know there was a lot being made about Goldman Sachs and Marcus and the Apple Card. So I don't know if it has to do with that. We can look at Baba having a good day again today, up another 2.7%, getting up to that $120 level, but ooh, found a little typo in this whim. Sorry, guys. I got to. Alrighty. Anyone got any stocks they wants to check out in the chat? Just keep your guy Steve Clasion to talk Apple down. I mean, I don't know. I think Apple will be fine. I think, like I said, just while all the other like tech and growth stocks were getting crushed, Apple kind of, so basically like everything was going down. I think Apple still went down, obviously. I mean, it was trading at like $185 a share and it's $130 now. But compared to a lot of other names, it stayed higher. I think because people are willing to pay that premium for Apple still, both the stock name and the products. And that now basically that all these other names probably catch up to like the ratios and where Apple's at right now before Apple really starts taking off again. But I mean, I would still, I mean, if you're, again, it all depends on your time frame. So if you were looking at buying and holding Apple for you know, a very, very long time, then obviously that's a little bit different. Apple, they were hiding out in it. Exactly. And so basically, you know, if Apple, say, went down 25% and a bunch of other stuff went down 40%, the other stuff would have to catch up another 15% to get back to Apple's down 25%. So again, I just don't, I'm not shocked to see Apple trading a little bit behind some of these other names right now because it was trading well ahead of some of the other names for a while. I see some people talking about crypto in the chat. We haven't talked much about crypto the past couple weeks on the show, but Bitcoin, Ethereum, all the big boys have just been showing a lot of strength. I don't know really if it's like fear subsiding in the industry. I think at one point a lot of people, you know, really questioned like the longevity of the whole industry after FTX. I mean, the biggest. There was a lot of made about Binance's you know, situation. If Binance would go under, then you have Genesis, all this stuff. But at the end of the day, I mean, it looks like there's appetite out here to be buying Bitcoin. Maybe it's just, you know, coinciding with stocks being a little bit stronger too the past few weeks. I mean, look at S&P 500s. Oh no, that's a 10-minute chart. See, that's just what's weird is even like stocks have kind of come down. Like Bitcoin and crypto have been outperforming the stock market over the past couple weeks, which is insane. I mean, I don't even honestly know what to make of it. Is it time to start buying Bitcoin ETH? I don't know. I'm personally not with any, you know, like I wouldn't put a significant percentage of my portfolio in Bitcoin or Ethereum right now. If you really believe in it long term, I mean, it's still obviously heavily discounted from where it was trading at a year ago. But again, I don't think just because it's just something's cheaper than it was a year ago is a reason to buy it. So I don't know. I think, you know, let's check out what Coinbase, the stock, is doing, up 6% today. Yeah, I mean, so it seems like there's a lot of fear subsiding in the industry. People saying, okay, you know, FTX, SBF, they were bad actors. That's not the whole industry. And there's also, outside of what was going on within the crypto industry, again, FTX, SBF, obviously the biggest, but then, you know, Binance and Genesis and all this stuff. I think you also have to look at macro conditions, and it could be people just betting on that the Fed is going to stop raising rates or end up cutting rates sooner than people think or whatever it is. So, you know, I don't know exactly what to make of the crypto, of the price move in crypto. Happy for everyone that's still been holding crypto because, I mean, ETH had an incredible... What's going on with our charts here? ETH has had an incredible run here. I mean, came down to... go to the daily chart. Not weekly. Man, I almost bought ETH. Not almost. I did buy ETH like right at the freaking bottom. I'll show you guys. Let's go to my Robinhood. I pulled basically all my money out of my Robinhood. ETH History. I bought a full ETH at. Oh, it was on Christmas. I bought a full ETH on Christmas for $1,200 and $1,223. Let's go back to Benzinga Pro real quick. I ended up selling it because I sold it. I don't even remember why I sold it. I don't even remember why I bought it, to be honest with you. I mean, I almost bought it. I got it at 1,200, like right. What was it? I guess I got it like up here. So I didn't bottom ticket exactly, but pretty good. I would have made some decent return on it. I think I would rather buy ETH than Bitcoin right now. And I don't really have a great, like fundamental or logical reason for saying that. I just think I think I think this is a fine explanation for my logic there. I think in the environment that crypto in general and Bitcoin does well is this like high growth, speculative environment. Basically, the perfect environment for crypto and Bitcoin is exactly what we saw post, COVID, right after lockdowns, when interest rates were near zero, people had extra income, and people were kind of antsy, right? People have been locked down or whatever, so it's like, okay, we want to buy this ETH or Dogecoin that everyone's buying. Let's do it. Again, I think that's what's good for crypto overall. A low interest rate environment where people are willing to take financial risks, people are willing to take on speculation. In that environment, I think an ETH, which is like going to be seen as kind of the more riskier, growthier opportunity compared to Bitcoin, which is, in my opinion, going to be seen as more of like the store of value. Like I see it as like Bitcoin is like the gold of crypto, whereas ETH could be more growthy. So if I was shooting for like 100 or 1,000% return, I would go with ETH over Bitcoin. And again, I think the environment that they're both doing well actually favors Ethereum over Bitcoin because people are willing to take the more riskier option. See, Christopher Marin has a different reason. Agreed on ETH over Bitcoin. Deflationary aspect now makes it a better buy, and you can stake it for 5 to 10% APY. FTX collapse could very well have been the short-term bottom. Yeah, and I think that's, again, like even with let's go back to Google's chart. That's kind of like the biggest news on the street today. I'm not saying this is the bottom in Google's chart, but like, and I guess today wouldn't be the bottom anyway, but I think when it's all said and done, a year from now or 2 years from now, if you look at this chart and you kind of circle in on this area right here and you realize like, okay, that's when the company was announcing layout. Like, I think that's actually what happens a lot is that you see markets bottom when the news is bad, or you see stocks bottom when the news is bad, or in this case, Jay Rice is saying that for crypto, the bottom, short term at least, could have been the FTX collapse. Let me just make sure. All right. Sean's got the link, so he should be hopping in any minute. I got to get my man. At 12:45, we're going to have my man ES Invest, Eric, on the show. So yeah, today's a great day to get Aaron from Glassdoor on the show to be talking about layoffs and whatnot. Rare days when Qs are up, TLT whacked, and DXY green. Yeah, I know the dollar and stocks have kind of, they've been inversely correlated. Days where the dollar's strong, stocks are typically down, and vice versa. And it makes sense, right? Because the dollar's up when the Fed is tightening and showing hawkishness. But I also think there's a part of it too, where from people like trading Forexes and stuff and how the monetary exchange works, is that when people look at the landscape the macro outlook of the world right now might just be kind of looking at and thinking, okay, the U.S. is actually in a pretty decent position compared to a lot of Europe, or even compared to something like China right now, who's seeing a lot of obstacles and a lot of speed bumps as it's kind of, rolled back its zero COVID policies. So we shall, what do we think about Estee Lauder? This is another good example of what I was talking about earlier, where the past 6 months or so, the cheaper names have been outperforming. So Estee Lauder is seen as kind of the more luxury name in the makeup space. And if you look at Estee Lauder's chart, topped out almost to the day a year ago, January 2022. Almost $400 stock came all the way down to lows, so it cut in half. The stock got cut in half. So that's Estee Lauder's chart. Now take a look at Elf's chart, a name in the same exact business of making and selling makeup. And Elf's chart was making new highs this January, like 2 weeks ago. So because we were in this environment where, high inflation and people were forced to cut back on spending, for whatever reason, or maybe for that reason exactly, a lot of these pairs, if you look at competitors in the space, the cheaper option, and I'm not talking about stock-wise, I'm saying the company that makes the cheaper product has been outperforming. We looked at earlier with Nordstrom's is a luxury department store. Compare that to Ross Dress for Less, the exact opposite of a luxury department store. Ross's stock has been outperforming. Walmart. Look at Walmart's stock compared to Target's. And I think it makes sense, right? If you're usually shopping at Target and you're making a little bit less money, or, inflation's hitting, and now you start shopping at Walmart. I get it, but I think we might start seeing that start to shift as in my opinion, if we start looking like more economic conditions are getting better. EL been a monster since they took it down on that acquisition, very similar to Crocs when they bought another company. SPY getting ready to explode. Big money getting out of all their short positions. I mean, you guys have known, or anyone who's watched the show has known, that I've kind of remained bullish, and even at times where it's made me look super wrong when the market's gone down another 10% in 2 weeks, and I'm but my thesis never has changed and still hasn't changed, in that I understand and I recognize all the risks and the bad things people are looking at, whether it's inflation or supply chain issues we're still dealing with, or all these things. But my point has always just been I don't think it's as bad as some people are making out to be. And I bring up this example a lot, but remember 6 months ago when people were saying Europe wasn't going to make it through the winter, that the UK didn't have enough energy? And I sat here on this show through all that and had people on the show telling me about how bad the energy crisis in Europe was going to be, saying I don't know, maybe it could be. I'd rather wait and see this winter if that happens, rather than start selling all my stocks now because we're worried about some energy crisis. But again, I said it yesterday on the show. If you had to put it on a 1 to 10, 10 is the most bullish you could be, 1 is the most bearish you could be, I'm probably a 7, a 6.5, 7. I'm bullish, but not the most bullish I could be. And I'd want to see some of these things get a little bit better before, I go full bull. But speaking of, I'm curious how the AAII, the American Association of Individual Investors Sentiment Survey, is looking. Oh no. All right. See, I hate this. So now people are getting more bullish. All right. Well, it's still, look, you still have way more people. You have double the amount of people that are either neutral or bearish than there are bullish. But even a month ago, you look at week ending in 118 versus 1228, almost 50% of people were bearish a month ago, and now it's 33%, which we talk about all the time. Price really determines sentiment. If the market keeps going up, guess what? More people are going to get bullish, less people are going to be bearish. If the market goes down, there's going to be more bears popping up. So it's really, I don't know, honestly, how impactful it is to look at this data, because I think at the end of the day, again, it's driven mostly by price. All right, guys. I see our first guest hanging out backstage. My man Sean Dekmar. It's been a while since we've had him on Benzinga's stream. Usually streaming on his own channel or to his own group, but believe takes Fridays off, or at least in the afternoon. So lucky enough to get Sean to join us today. Let's go ahead and give Sean our very special Zinger Nation welcome. Roll that intro, and we come back. We'll be talking to Sean about what stocks he's been looking at and what he's been trading. What is up, Sean? Welcome back to Benzinga Live. How you doing?
Good. How you doing, man? Thank you so much for having me.
Good. So, what's new? How's your trading been in the new year?
Everything's good. I mean, going into 2023, I'll be the first one to say I am so happy and so excited to be going into 2023. I think I can speak for a lot of people that says, hey, 2022 is over. Let's head into this new year. Let's make it the best year yet. 2022 was a very tough time. And I'll be honest when I say it was nowhere close to one of my best years ever. I finished off in the green, but it was a year that I was honestly just saying, hey, let's get to the end of this and let's start fresh with 2023. So the market's been a little crazy. We're starting to have a little bit of a bounce right now. But to be honest with you, I still think there's some more downside ahead. I still think we're going to be having some drops and could be seeing a brand new 52-week low within the first 6 months of the S&P 500, and then maybe the back half of 2023 we could starting to see a little bit more of that bull rally.
Yeah, and I mean I think a lot of people have been antsy for this bull rally, and honestly, I don't think it's even just retail. I mean, I know a lot of institutional and a lot of big banks have still had money like parked on the sidelines, really going back since. I think a lot of people took money up. A lot of big players took money off the board, when the COVID markets got a little crazy, thinking, okay, maybe we've made some good money here. So what do you think we need to see? I mean, a lot of people obviously are pointing to the Fed and saying, okay, when the Fed starts cutting, but what are the signs you're looking for in the market before you can really go like full bull?
I mean, basically, what you've already been stating is that it really does come down to it's impossible for the markets to climb while we're still raising rates. It's just a simple cycle. And, a lot of people say, don't try to time the market. And I understand, don't try to time the market, but you can time the market in some sort of sense when the same things happen cycle and cycle and cycle over again. So many people move into the brand new year and we expect to see some sort of different result. Everyone says to themselves, hey, 2023 is here. Let's see this market go all the way back up to 480. Let's see it go all the way back up towards pandemic highs. The thing is, we're doing the same exact thing that we had last year. If we continue to raise rates, let's expect to see the same exact results. Something I tell my chat all the time is, imagine if we woke up every single day in 2022, we ate candy bars, ate ice cream, we went to sleep, played Fortnite. All we did was sit there. And by the end of the year, we were a huge person, super overweight. In 2023, we could say, hey, I want to be skinny. Hey, I want to be in shape. But if we do the same exact thing, keep waking up, eating ice cream, playing Fortnite, we're still going to look the same. Same exact thing with the market. We raised rates, 8 times last year? We are going to raise rates probably another 3 times at least, starting off, 2023. I'm not expecting to see any sort of market direction on some sort of different trend than what we're already on at this time. The S&P 500 is continuing to fall. Rates are going to continue to rise. After we have rates, we have to pause rates. And then from there, we are going to be finally cutting rates, where Jerome Powell doesn't expect any cut rates to be happening until we head on over to 2024. Some people expect that may be a lie. They may be thinking we're by about like October or November, we may start cutting rates. But regardless, we aren't going to see that really true bull run until we start seeing at least pausing rates. And then on top of that, cutting rates. In my timeline, I'm expecting that the final rate hike is probably going to be in May. I think, again, we're going to be pausing rates over the summertime. And it's kind of up in the air if we are actually going to be cutting any sort of rates before we get into 2024. But as this market continues to fall, as this market continues to drop, there's no part of me that wants to be buying in just yet. I'm not going to FOMO in at this time when we still have more rates to cut and we're just still slowing down the economy. But the big thing that we also see a lot of times is Google today. Google just announced that they've had so many different layoffs. We've seen Microsoft have layoffs. Some other big blue chips are having layoffs. And And we are going into a very crucial time this week, which is going to be earnings reports into next week's earnings reports. And then on February 1st, we have the Fed first rate hike. So a lot of people got excited about this last 7-day bull rally that we saw to kind of kick off this year. But this is starting to turn. And especially as we're starting to get these earnings reports coming out right now, things are not looking as good. And banks have already kind of kicked that off, showing that these numbers aren't that great. And could you imagine if we have, let's say, the next 2 weeks of bad earnings reports just to top it on off with some bad rate hikes coming on up, in about 2 weeks on February 1st. So I'm still thinking, market's going to be dropping for a little bit until we, again, really have that clear cut. Rates are being cut. And that's where, the true bull market, would really start. And that not only goes with stocks, but also, Bitcoin and cryptocurrencies. You were talking about those earlier. And
Right.
it's one of those things that I think we all know, especially as an experienced trader, what to look for. But the hardest thing to control is going to be right here. Seeing, again, Tesla down towards $100, seeing, some of our other plays, NVDA or Amazon or Meta or, Apple down towards areas where we say to ourselves, man, this is a juicy area. This is an area that I would love to be able to jump in. But I can't pull the trigger just yet. If you do pull the trigger right now, I can understand why. I get it. I'm not saying it's a bad entry, depending on if you're holding long term, but I think there is still a little bit more coming on down in the South.
Yeah, and you bring up Google, who again announced layoffs today, but the stock's trading up. I mean, it's up more than 4%, and I mean, we have big earnings coming up. But what if, I mean, like, and I anticipate as well that like companies like Google, big companies, are going to report maybe not so great earnings, or even maybe worse, scary guidance or scary forward looking. But if I see the market reacting this way, right? If I see Apple reporting saying, okay, we're going to sell less phones, less MacBooks this year or whatever, and the stock doesn't take a big hit, I'm going to see that as a sign, Sean, that the market is starting to say, okay, like we're brushing off some of this bad news and saying like Apple at 125 or 130 is a fine buy for the long, whatever. So I don't know if today's action on Google is an anomaly or if that's kind of a vibe shift we're seeing throughout the market right now.
Mm-hmm. Yeah, I know exactly what you mean, because I always like to, I don't want to be biased. I don't want to, just because I have my opinions, I don't want to impose them on other people. It's saying to other people, oh, don't buy in, don't get involved in this play. Because, a lot of times I might say, hey, we're going to keep cutting interest rates, or sometimes the economy or how the current stock market is doing doesn't always correlate with, let's say, how, the economy is doing. I mean, we could take a look, and a perfect example would be the pandemic. When we had the pandemic, the economy was hurting. People were losing jobs. People were, again, struggling in their everyday life, but the stock market was thriving. So I do always want to try to understand both sides of it. I do still personally believe the market's going to definitely still take a little bit of a hit. I still think we have to go through our normal cycle with, again, cutting, raising rates, pausing rates, and then eventually cutting rates. But I can understand your side as well, where we sometimes have, what seems to be bad news. Hey, layoffs are starting to happen. Google's up today. But, one of the biggest things is when it comes down to blue chips, when it comes down to these larger cap stocks, the best thing to do a lot of times is to get into a larger time frame. Sometimes we look into those 1 minute, 2 minute, even on like this exact day of just today, and we say, oh, this doesn't make sense. Why is it doing it? But when you zoom out of the chart and you start saying to yourself, okay, let's not focus on today. Let's focus on the overall month. Let's focus on the overall trend. That's where I just think we have a lot more predictability. When we can be able to zoom out and we can be able to say to ourselves, all right, where's our resistance? Where's our support? And I think that's where we could be a much better trader. I think a big reason why a lot of option traders do take losses, especially when they trade, let's say, the S&P 500 or Apple or Google or any of these plays, is being in the 1 minute chart or just being in the actual day trade of today is very difficult to be able to figure out. You have to be a very special trader, and you have to have a lot of studying experience to be able to figure out every little tiny move. But when it comes down to blue chips, it's a lot easier to honestly figure out a weekly move, or even easier, a monthly move. There's always going to be those unknowns. There's always going to be those weird press releases or different data that may come on out. But I definitely understand your side of it, that layoffs happened today on Google and the market's on up, or again, we're seeing Google on up. That is one of those, tough things about the stock market, which makes it the stock market, where people sometimes say, hey, why is it every single time I buy, the market moves up? Why is it every time I sell, the market, goes down, goes in the opposite way that we want? So, that's, I definitely am taking that with a grain of salt and understanding, your side of it as well.
Yeah, and I think, on the flip side to it is when I think back to kind of around this time frame where my cursor is, like November 2021, when we were starting to get kind of topped out. If you remember this quarter, like when all the big companies reported this like at this time frame, I think like either maybe it was January 2022, whatever, like all their quarters were like record breaking, best all time. And none of the stock, Apple, Microsoft, Google, all literally blew it out of the water. Great quarters. And the stocks didn't really like do anything because I think the market was recognizing, or big players were recognizing, hey, even though Google just had the best quarter they've ever had, we're worried about inflation and the Fed having to raise rates. And so like, that was like a sign, or I guess in hindsight, I didn't really see it as a sign at the time, but in hindsight, that was a sign that maybe the market was topping out, that these stocks weren't running on on good news. So if this earnings cycle, I think, will be pivotal, and if the companies, like I said, I anticipate, and like you said, like are having tough times, having to lay people off, having to cut costs. And if we hear across the board all the big names say this, and those stocks don't get hammered down, I am going to see that as a pretty bullish sign. But that's not really what I'm expecting. Like you, Sean, I'm going into the earnings season without a bias. And if all those stocks do get crushed on bad reports or bad guidance, I'm not really going to see that as anything other than a buying opportunity on some of the big names. If Google gets back down to like, $80 again, or Apple back down to like 120 or 115, like I don't know, if that means the whole market's going to crash essentially if we do get a bad earnings cycle.
Yeah, no, I agree with that. And that's the thing that I'm saying, right now, for anyone that's getting involved at these prices, I would never disagree with anyone if they said, oh, I'm buying a Google right now. It's down, I don't know exactly how much it's down. It's down 40% in the year. Oh, I'm getting over 2022. Oh, I'm getting involved in Tesla right now. Do you think Tesla's a bad play? It's down, 55%, from last year. I'm getting involved in Apple, down 20%. I don't think any of these are going to be bad investments, long term. We take a look at these companies. Right. Yeah, these companies are amazing companies, and they all are expanding, they're growing, and they've been amazing investments. You can't really go wrong when you are going with, let's say, some of these top 10, top 20 companies. They're going to get their bounces. And when we get back into that bull rally, we will be able to see them go on nice rips. So I don't want anyone to take that out of context and be like, oh, Sean doesn't want anyone buying anything. He thinks it's going to go lower. Wait for those lower prices. I think, again, the best thing to do is, if you believe that these are going to be the best prices we're going to get, start adding a little bit. I don't want you to add everything you have, but you know what? Add a little bit, have some skin in the game. And if you do go lower, then you can add a little bit more and average down. This is not an averaging down position where it's basically, buying into a falling knife. This is not an averaging down position where it's some sort of penny stock that's never going to come back down on you or be able to move back on up. This is Google, this is Apple, this is Tesla. We will be able to see rebounds, but the magic question everyone's trying to figure out is, where will the absolute bottom be? And, a lot of people, the FOMO was already hitting. Oh, I missed the bottom, back in whenever it was June, when we saw the S&P 500 all the way back on down towards 348. That was the bottom. I can't believe I missed that. Now, again, people are saying, well, I don't want to miss it now. Right now, the S&P 500 currently trading up in the 390s. I want to make sure that I'm in on this position before, of course, we cross over towards that 400 mark again. So FOMO is definitely starting to take its a little bit of effect. But I still see, honestly, a very large downtrend. Is there, if I can, Aaron, is it possible if I could share my screen and just kind of show the chart that I have at this time?
Of course.
What I just present and then share screen?
Yeah, present. You can do it by, typically it's easiest to do it like by tab or by window if you have a software or a specific screen, because if you do your whole screen, it can just get a little convoluted and
gotcha.
Jumbled.
Let me see here. Share screen. All right.
Yeah, I'm always curious to see how different people have their chart setups, and like what indicators you use, and really what you're looking for in charts. Because we were talking about it earlier on the show. I mean, it's really like, you're looking at a chart, it's like looking at art. Everyone can interpret it different ways.
Absolutely. So this is, I'm just going to make, everyone's life's easy, and I'm just going to start this absolute from scratch start. This is the daily chart right here over on the S&P 500. Let's just right here. This is just bold, straightforward S&P 500 daily chart from the present day all the way back to August of 2021. This is showing all of 2022 right now. And if we wanted to, we can literally just connect the dots throughout 2022, and we can still see that we are on a downtrend throughout 2022. This downtrend is continuously holding. Why would we go against this downtrend? All we have to do at this time, if we want to be as smart as we can as an investor, is if you are a person that is bullish in the market and you're saying, I want the market to move on up, don't we believe that probably the best entry, at least to kind of back up that statement, would be let's wait for a break of the downtrend that has been holding throughout 2022? We have seen 1 touch, 2 touch, 3 touch, 4 touch, 5 touch, 6 touches. And every single time that we have hit this purple line, this downtrend of 2022, we've had a 2.5 month drop. We had a 3.5 month drop. We had a 2 month drop. We had a 1.5 month drop. And we actually just hit this downtrend of 2022 once again last week as we came on up towards around that 400 region. A lot of, again, traders that I know started doing long-term put contracts, about 3-month out expirations, put contracts, S&P 500, SPX, looking for drops all the way back down to 350. Because if we just went off the pattern, that is what is showing us right now. You touch the purple line, you get about a 2-month drop back on down. And until we break this downtrend, that's honestly what we have to stick with. But for the bulls, there is something positive, because I know right now I'm sounding a little bit bearish, saying, oh, I believe it's going to go lower and lower. We have to be able to say both sides of it. So I still do see a very nice uptrend at this moment. Now, this uptrend started forming back in October, and let's just put this in a nice purple line here, where we can see we've gotten our bounces, and we have a clear-cut bounce right here and here and here as we're getting tighter and tighter. Now, what's the best thing about getting tighter and tighter? We are forming a very large wedge pattern on the S&P 500, where, to be honest with us, all we have to do is play this in a very simple manner. We look to buy near the bottoms, and we look to, of course, do put contracts up near the top. Buy the bottom, put contract up at the top. And everything in the middle is going to be a little bit random. When I said that it's very difficult to trade in that 1 minute chart, the 2 minute chart, it is tough, because if someone asked me which way is the S&P 500 going to go right now, I really couldn't tell you. I couldn't tell you if it's going to go up to 393 and drop back down to 391. I couldn't tell you if it's going to go to 395 and go back down towards 389. But what I can tell you is when you get up near the area of 398, you have massive reward and you have low risk. Because if you want to do 2 different trades, you could do a put contract at 398 with a stop loss at 401. If you break 401, we're breaking the downtrend that's lasted the last 13 months. And there's going to be most likely a lot of bulls that are going to push in on this play. But if you do a put contract and let's say you fall on down, you have massive reward. So you're risking little for, again, a great reward. Same exact thing if you wanted to do a call contract at 383, put a stop loss at the price of 381. If you hit 381, we're cracking that 3-month uptrend. But if, of course, we do get the bounce play, which has happened multiple times previously, that's going to actually bring in a lot of strength. And that's going to lead towards the market being able to move ourselves back on up. So at this time, what I've told, again, all my traders is let's stay away from the S&P 500 until we're either at our top, either at our bottom, or until this wedge increases. I actually posted this today on my Twitter, this exact chart where it said, this is a ticking time bomb right here. Like, this is a ticking time bomb at this moment. The S&P 500 is going to get tighter. It's going to get tighter and tighter and tighter in this wedge, and it's going to have to break the last 13-month downtrend, or it's going to have to crack the uptrend of 2023 so far. There is no way we're just going to continue to move sideways. When we go on up, if we break it, we will get a nice bull rally. And if we crack this trend line, we will be going down. So this is why I want to back up and say, while I want the market to fall so I can get a better entry, I can't say it will fall, because if it breaks that downtrend of 2022, imagine how many people are going to be excited about this type of play. So, the S&P 500, that is, what I'm honestly focused on at this moment, really just kind of taking everything back and really just looking at this daily chart. But as I said, going into the 1 minute chart here, 1 minute chart S&P 500, it's a little bit gambly. People want to buy in, then they sell, then they lose, they buy, they sell, they lose. They try to figure out every little candle. Take a couple steps back. If you need to, you can also go back to the 60-minute time frame, be able to get a little bit of better kind of look on this play. Something that we also can take a look at if you want a little bit more closer detail is, why did the market bounce at 387? Yesterday we saw a nice bounce at 387, something that I called out as well. And this was just because I'm here every single day. I love watching the S&P 500. Old resistance turns into new support. We actually had a beautiful channel pattern in a 60-minute time frame from mid-December to early January, where we had our top resistance and bottom support. And this is just a channel pattern. Top resistance 387, back down to 378. Top resistance 387, back down to 378. 387, 378. And it's back and forth until we break out. You can see we bounce off it here. We bounce off it here. Old resistance turns into new support. We start moving back on up. Let's take what we just learned from this channel pattern, up and down, up and down, up and down, until we break out and get a nice move. And let's just apply that over to our daily chart. And you can also see, of course, bounce play right here. Now we're getting a little bit more detail. And that's where you can just slowly keep adding onto your chart to be able to find support and resistance. But this is where I'm completely at in my mind.
Yeah, and I like, Sean, the way you have that wedge set up, because you're basically not saying I'm not, betting on SPY to go up or down, or I'm not super bearish or bullish. You're saying here are our levels, and we're either going to break higher or lower, like through one of these levels. And once that happens, then I'll be able to make my decision on how I want to directionally trade it, which I think is the more sound way to go about it if you are going to try to trade off charts, rather than saying, because when people just say, okay, I'm super bullish or I'm super bearish, you're going to see what you want to see in the charts, right? Like, if a super bull could look at this chart and see, okay, well, we've been making...
If I was biased on this, I would get rid of this line right here. I would say, look at the higher lows that we have. I could, say, oh, next time we break through, 400, look at this ascending triangle pattern squeezing on up.
Right.
I definitely could. It's easy to be biased towards the side that you want. Then you just go on Twitter and you only read the things or listen to the things that you want to hear, so you have an excellent point there as well.
Yeah. And I think you made some great points today, Sean. It's been a pleasure to get you back on the show. Unfortunately, we are running up on time here, almost 12:30. Where can folks in our audience find more from you?
I'm live every single day over on tradecaster.com. That's where I live stream my trading. Not only do I live stream there, but we also have roughly like 10 to 12 other live streamers just like myself, that trade full time, that you could be able to watch me trade, watch others trade, and be able to join our chat and join our lobby. So, that's where I'm live every single day. And, shout out to you, Aaron. Thank you so much for reaching out, and Benzinga and Hole for being able to have me on today. So again, I really appreciate it.
Of course, Sean. Thanks again for hopping on. I'm dropping that link in the chat, tradecaster.com. We got to get you back on again soon, Sean. I know you're typically more free on Fridays, correct?
Yeah, Fridays, even sometimes during lunch hours, I'll be happy to kind of talk and, what my thoughts are. But yeah, reach out to me. Happy to be on here whenever you guys can.
Awesome. All right, Sean, we'll enjoy the rest of your Friday. Have a great weekend, man.
Hey, thank you. You too.
All right, y'all, that was Sean Dekmar, tradecaster.com, to check out more from Sean and some of the other traders working with them. Sean's always, I love the energy Sean brings, right? He's going to come on, show you his charts, but really get you through it. Coming up, our next guest, I see you hanging out backstage, Aaron Terrazas from Glassdoor. We're going to be talking about what's going on in the labor market. And really, I didn't plan this, guys, I swear to God, but a great day to be bringing Aaron on with, of course, the Google layoffs. 12,000 people, Alphabet laid off today. So I don't know. I mean, we'll ask Aaron how many of those 12,000 are going to be making accounts on Glassdoor over the next couple of days. So if I get a thumbs up or something from Aaron that he's good to go, we'll go ahead and give Aaron our special intro and bring him on the show. There we go. Aaron from Glassdoor, how's it going? Welcome to Benzinga Live.
It's going well. Thanks for having me.
Of course. How badly did I screw up your last name? Terrazas? Is that okay?
Terrazas is great. Yeah.
Terrazas is great.
It's gonna be a little confusing on this with the two Aarons.
Yeah, we'll try to figure it out. It's even more confusing because I'm Aaron B, and here in the office we have an Aaron T, but you're also Aaron T. So if I say Aaron T, that we're not going to know who I'm talking about now.
Yeah.
So Aaron, what do you do at Glassdoor? And maybe you just give us I assume most people know what Glassdoor is, but maybe for those who in the audience who don't.
Sure. So I'm chief economist at Glassdoor, and for those who aren't familiar with Glassdoor, we are the worldwide leader in salary and company insights. So millions of people come to us to understand how much they should get paid and what it's like to work at a particular company when they're on the job market.
Got it. So a lot has been made about, the labor market as a whole right now in terms of the stock market, as well as wage growth in general. We saw throughout COVID, wage growth was very strong. And people have been pointing to that as, kind of one of the drivers of inflation, that people's wages have been growing so much. Have you seen that start to slow down at all at Glassdoor?
So we did see wage growth start to slow down in the most recent December data from the jobs report. Wage growth was about 4.6%. That's the slowest it's been since August 2021, when the labor market really started to heat up. So there are signals that kind of wage growth is slowing, the labor market is cooling. But it's important to keep in mind, wage growth was never the biggest force pushing inflation over the past few months. It really was a supply chain problem. It was a global commodity price problem. The fear was that all of those were going to make wage growth permanently higher. I don't think we're seeing that. Kind of the labor market is cooling, and we're starting to see in the data. A lot of those fears were probably misplaced.
Got it. And I think a lot of those fears increased, I guess, when the Fed started raising rates, and a lot of people expected that almost immediately we'd start to see the labor market cool down and thus see that wage growth start to slow down. And that wasn't really necessarily the case. What do you make? I mean, do you think even like Jerome Powell and the Fed would have expected the unemployment number to start coming up by now? Since, I mean, they started raising rates, what, 7-8 months ago?
Yeah, it's been a while, and of course, conventional wisdom is that monetary policy operates with these long and variable lags, and so you'd expect some time delay between when the Fed starts to raise interest rates and when we start to see that impact in the real economy. I think sometimes we get a little bit confused because labor market data are so high frequency. It is kind of this real-time pulse on the economy, but the reality is they are a little bit backward looking. If you think about all of the process that goes into hiring decisions, kind of getting the budget approved, posting a job, interviewing candidates, getting them on payroll, the reality is the payroll data are quite backward looking. And so even the most recent December data, the January data that we're going to get in about 2 weeks here, are in some degree, reflecting decisions made months ago about when and where to hire. So I think kind of the conventional wisdom is that it's just a matter of time before we start to see the labor market data slow down.
Got it. And is that maybe why you always see there's like a lot of times a lot of big revisions on like jobs numbers months after the fact?
It's one of the reasons. I think kind of the major reason for the revision is less about the pace of hiring and more just about incoming data streams.
Got it. So one thing that I've found interesting is I think, on CNBC or CNN, there's been a lot of airtime given to the companies that have announced layoffs the past few weeks, but also over the summer when a lot of tech companies really started announcing layoffs. So, today, of course, Google announced 12,000 jobs, Meta, Amazon, you name it. But I feel like an impact of that has been that a lot of people think, because they see those headlines, that there are like these mass layoffs happening across the board. But then, when you look at either the jobs number or even just the unemployment rate, things seem to look okay. I mean, what do you make out of those two things?
Tech and these massive tech companies, these consumer-facing companies, clearly hold a disproportionate place in our collective imagination relative to their actual place in the labor market. And so I think we do tend to over-index on what is happening at these companies. You think of all of the layoffs, as big as they have been and as kind of disruptive as they have been for many people's lives. Tech is anywhere from 5, maybe 7, a generous definition, 12, 13% of the labor market. It is a big part of the economy in some communities, in some parts of the country. But for the vast majority of the country, it is not, that big of the labor market, that big of a part of the employment. And so I think we need to keep that in mind. Overall, the number of layoffs we've seen over the past few months, as they've accelerated, maybe we're approaching 200,000 in layoffs. If all those people did not find jobs within, a quick amount of time, that's about a 0.1, maybe a 0.2 point increase in the unemployment rate. It really is, in a labor force of 150, 160 million people. It is important to keep that in context.
Yeah, and again, I mean, I think it's partly honestly how it's like reported on the news. It's not like they don't give the context of saying like, oh, Amazon, Meta, and all these people announced layoffs, but the unemployment rate remains, relative to the lowest it's been in the past 20, whatever, like we're pre-COVID levels, all this stuff.
Yeah.
Go ahead. Sorry, it sounded like
and all the evidence to date suggests that a lot of the people who had been laid off in November, October, and December are finding jobs relatively quickly. Maybe they're not necessarily finding jobs at these, big 5 tech companies or even at tech companies at all, but they are finding other jobs. And to some degree, there has been the more traditional part of the economy scooping up this talent. So tech is becoming a little bit less techy, and the traditional economy is benefiting from these skill and knowledge transfers.
Yeah, and I found that really interesting because, again, like over the summer, I think it was like July when a lot of these companies like really started doing some of the layoffs. People in terms of the market, like, oh my God, this is a sign of like, just look, these are the first layoffs. It's just a sign of what to come. And like these people that were super bearish. And I always kind of said, like, these companies have grown so much, not only just throughout COVID, the tech companies, but throughout the past like 20 years. If they need to cut a few jobs because the Fed's raising interest rates, like, I'm not going to see that as, like some Chicken Little, the sky is falling sign. If I start seeing FedEx laying off drivers, Walmart laying off employees, like people that are more day-to-day in the day-to-day economy where people are spending money, not like these big tech companies, that's when I'd start to get more worried about layoffs. Have we started to see some of those, like, FedEx laying off drivers or Walmart laying off, employees at their stores?
Layoffs have not been limited to tech companies. They have been much smaller, a little bit more targeted and selected throughout the rest of the economy. And of course, the fear is that the tech economy and these tech workers have been a large part of consumer spending. Do these companies that these large companies like Amazon, like Facebook, do they see something coming that the rest of the economy doesn't? I think that's the fear. The fear is also that the workers will tighten up their spending. So there are risks out there that we shouldn't diminish. But I think it's easy to overstate it. Again, a lot of them are still finding jobs relatively quickly. Maybe not kind of the exact type of job or with the same kind of compensation that they had previously. But for the most part, it does look like they're finding new jobs relatively quickly.
Got it. So yeah, I mean, that's just what I've been curious about is, I guess, more like the blue collar jobs, if there's been as many layoffs as like the big tech.
Right.
But so I remember a few months ago, or maybe, I can't even remember how long it was ago, 6 months or a year ago, say, like there was a time frame where I'm in my mid-20s now. So like this is my first job out of college, but a lot of my friends have now, or have switched to their second job out of college or whatever.
Mm-hmm.
But some of my friends just had crazy where they would like apply to a job and within 2 days they were getting interviewed, and then 5 days later they were hired. And these were for like big, like good white collar jobs in like finance or in, business. Is that still out there, that these companies are having like such trouble finding people that people are getting hired within the same week they apply?
Increasingly, it's difficult to characterize the labor market all in a single breath. The reality is we are increasingly moving toward a two-track labor market where for some of those knowledge workers, depending on your particular skill set, there are a lot more applicants suddenly out there, and very skilled applicants. At the bottom of the labor market, in the skilled trades, kind of going to what you were alluding to a moment ago, the labor market is still exceptionally tight. And so, it really is difficult to say the labor market is doing one thing or another. At the top of the labor market, there is a distinct chill, particularly for knowledge workers. At the bottom of the labor market, for skilled trades people, for frontline service workers, I think a lot of businesses are still having trouble hiring. Labor supply has been a lot slower to rebound at that end of the labor market than at the skilled end of the labor market. And a lot of businesses are just still kind of scarred by the past couple of years of struggling to hire folks, and are going to be a little bit slow to fire or to let go of people that they spent a lot of money and a lot of effort and sweat trying to hire over the past year.
Yeah, and I wasn't trying to oversimplify. I mean, I know how complex labor market is, but that's kind of what I was wondering was, is it safe to say that for the more white collar type of like finance jobs and stuff, maybe 6 months to a year ago was a little bit tighter than it is today?
Absolutely. There's no doubt that the white collar labor market, the skilled knowledge worker labor market, there is suddenly a lot more talent out there, a lot of talent with a lower reservation wage, eager to find something quickly than certainly there was 6 months ago.
I mean, I saw a crazy stat on the other day from a headline. It said something that like 96% of Americans will be like considering or looking for a new job in 2020. Like it was something like crazy. I couldn't even fathom like what that number was. But addressing that more from like an overall perspective, do you think there will be some sort of shift in the next decade, 2 decades, to try to get more trained skill, like trade workers, maybe like encouraging more high schoolers to go to a trade school as opposed to a 4-year university?
If you look at the long-term labor supply trends, kind of one of the things I've been telling my team is that we should probably be a little bit less afraid of 2023 and a little bit more afraid of the years that follow it. The baby boomer retirement is something we've been talking about for decades. It finally snuck up on us during the pandemic. The median baby boomer turned 65 in 2021. And so this wave of retirements that we've seen coming for a long time is hitting. Those people are going to be exiting the labor force. In their early retirement years, they're going to be consuming hospitality services, and there's going to be this need for workers, particularly to do those types of jobs that younger workers weren't necessarily trained or educated for, and involve lifestyle commitments that they may not be interested in.
Yeah, and I mean, I know specifically that's a big concern in the healthcare space. Will there be enough nurses? Will there be enough doctors to care for like
Totally.
an aging population in a few years? And I'm always curious that because I think I have seen that more and more where people are talking about now, like how many like I studied some sort, I went to journalism school, but studied some form of like, marketing and stuff like within there. And it's like, how many kids do we need going to college to study marketing? Like I've seen more and more people, talk about like, all right, we should try to encourage more people to go to trade schools and whatnot. And honestly, like if that labor market up on the more white collar jobs remain super tight, I wouldn't be surprised to see some like mid-20 people be like, you know what, screw that. I'm sick of looking for a job in business. I'm going to go be a carpenter. I'm going to go make, $40 an hour doing this. And it's, because like you said, there's a big shortage in those jobs.
I mean, the debate over skills has been around for a long time. It's something that economists and policymakers have talked about since the 60s and 70s. And I think there is this constant anxiety that the education system is not necessarily training the workers that our economy needs. Obviously, that is an enormous challenge to coordinate, particularly when, for much of the past 20 years, there was still a pretty meaningful wage and salary premium for higher education. So all of the economic incentives were still there to go to college and pursue kind of that track.
Got it. So something I'm curious about, as an economist and someone who works obviously at Glassdoor, so you're looking at labor and jobs data a lot. When you hear like Jerome Powell saying at press conferences and stuff, and he's like basically saying there will be pain in the labor markets or stuff like that, or almost that they're like looking for there to be pain as they're trying to bring inflation down. How do you view that? Do you agree with that? Do you, think the Fed has been doing a good job? Are you worried about their course of action?
I mean, I'm in certainly kind of not one to question kind of the deep expertise and kind of hundreds of economists on staff at the Fed. The reality is high inflation has eroded wage gains from the tight labor market over the past year. And so it's clear that is a problem wherever you sit in the labor market. High oil prices, high food prices have essentially erased all of the wage gains people across the labor market have experienced from a tight jobs market. So that's clearly a problem that is very difficult to ignore. Part of the challenge I think that the Fed is struggling with is fundamentally interest rates and the tools that they have are a demand side tool, and so many of the inflationary forces right now are really supply side. You can certainly lower demand for computers and televisions and gadgets through higher interest rates, but you're probably not going to necessarily lower demand for food and for gasoline.
Yeah, that's a great point. I mean, I know I talked about that a lot when the Fed first started raising interest rates, which it's like, all right, so some of the things that were driving inflation at the time were like, new and used cars, because there were all these semiconductor shortages. And it's like, all right, by raising rates, you're going to discourage these companies to invest in producing more semiconductors. And there's just going to be, you like you said, you can fix the demand side, you can crush demand, but you can't really increase supply. I guess theoretically, you could try to increase supply by cutting rates, encouraging more growth, more investments. But the way I mean, and I hear you, and obviously, like the Fed, people working at the Fed know way more about this stuff than I do. But like when Jerome Powell basically says, like, and he was saying this months and months ago, we're gonna need to see the unemployment rate like come up essentially to see inflation come down, and that hasn't really been the case. We've seen inflation start to moderate, at least somewhat, and we've seen jobs numbers remain strong, like almost as if like a soft landing has looked more and more possible. Yet for some reason, the Fed and the leaders themselves still are saying it's not a possibility, right? And to me, like, it's not fair because they're not. What's the sample size there in terms of like times we've had to try to like cut down inflation that's this high, dealing with all these things? Like, you're working off a sample size of like less than 10. Like, so it's to me to say definitively we need to see unemployment rise. We need to see people lose their jobs in order to tackle inflation. It's like I have a feeling that they're like almost ditching a dual mandate and just saying, all right, we're just worried about inflation right now. We're not really worried about unemployment.
That was certainly the hopeful message of the December jobs report, is that we did start to see wage growth start to come down, and unemployment, actually dipped a little bit. So the hopeful scenario is that we are already starting to see the labor market, at least when it comes to wages, cool without the massive disruption from higher unemployment. Obviously, wage growth is still high, higher than certainly higher than the 2 plus or minus a couple tenths% that is typically consistent with a stable economy. And so, for all we've talked about soft landing and whether it's possible, I think the reality of any soft landing, the handful of times that we have seen it in the past, is that there is, massive fear, uncertainty, and kind of occasional prayers up until the very last moment that the wheels touch the ground. So I think we need just to keep that in mind. The last thing that the Fed would want is for markets to get ahead of themselves and, for consumer demand to suddenly pick up, pushing back up inflation before we have kind of eyesight on the ground.
Got it. Yeah. And I mean, it's tough because I mean, I wonder too, with how much of like when Powell says that stuff, like we need to see unemployment come up and all this stuff, like you said, like they don't want to see the market get out of hand. Like how much of it is jawboning to the point where, because if you think about the Fed's whole post-Great Financial Crisis framework has been like built on how to avoid a situation like that, right? So like it would seem hard for me to believe that if they start seeing like cracks forming, banks about to fail, all this, that they wouldn't step in just because they're trying to get inflation down from 6.5% to, like whatever it, it would seem to me counterintuitive almost to like crush the whole entire economy. But the economy's held up a lot better than a lot of people, myself included, has expected throughout these rate hikes. So it's been interesting. And like you said, that December jobs report, I think a lot of people were calling it kind of the Goldilocks just right report for a lot of those reasons, that you did see wage growth come down, but without this huge uptick in unemployment that would indicate like a big recession, So, Aaron, anything else, that's been top of your mind that we haven't gotten to in this discussion?
Oh, wow. I think for me, just it is important to keep in mind that so many of these labor market indicators are a little bit backward looking. As we saw the news this morning, tech may be a relatively small part of the economy, but it does have a disproportionate part of our attention. And, those phenomenon can take a life of themselves. And so, there are real risks there that we shouldn't diminish. We shouldn't be exaggerating the downsides either.
Well, so if all these jobs data that we're getting from JOLTS and whatnot are so delayed, I mean, wouldn't you guys have more up to speed data, I'd assume, at Glassdoor?
I mean, certainly we see kind of job openings starting to slow from the really rapid pace last year, and I think a lot of the real time data are suggesting that the economy or the labor market is starting to slow.
Okay. Well, yeah, I mean, I'd be curious too, and we can talk obviously off air about this, but maybe if, I'm sure you guys are putting some of those insights together and out there, maybe we can use some of those in some of our reporting on the labor market some more.
Yeah, totally. Would love to.
All right. Awesome. Well, Aaron, enjoy the rest of your Friday. Have a great weekend. It was great having you on the show. I'd love to have you on again in the future. Anytime we need some updates on what's going on in the labor world.
Sounds great. Thanks for having me.
Of course. All right, guys, that was Aaron Terrazas from Glassdoor. Great conversation there about just what's going on in the overall economy and jobs market, labor market. But we got to keep it ticking. I see my man Eric ES Invest hanging out backstage. Been a few weeks, been too long since we've had Eric on the show. Honestly, this is like the first Friday show we've done probably since I don't even know, before the holidays maybe. But without further ado, let's go ahead and give Eric our very special Zinger Nation welcome. Bring on. What is up, Eric? How you doing?
What's up, dude? Chilling. Finally, the rain out here stopped. It's sunny. I see people ice skating behind you, which is hilarious. It's a good day. It's a good Friday.
Why is it funny to you that they're ice skating? Because it's like, what, 80 degrees where you're at?
Yeah, it's pretty warm out here today. Of course, it's getting kind of like chilly at night, though. So, yeah, just still quite the contrast to what's outside right now.
Oh, Eric, sorry. I missed your... I didn't even see your first...
I was hitting you up on the back end. So I love talking to dudes like that. I'm so fascinated with the economy and just labor markets in general, but it's all good, man. I actually wrote his name down. I'm probably going to hit him up because I look to get a lot of perspectives on that. I try to integrate it into my trading, but beyond that, it's just so fascinating, man. Like the way that all this stuff comes together, it's insane.
Yeah, I think if I like had to choose like a alter ego or like another thing, I would just be like the most like boring economist ever. Like I would literally just like read economist books for whatever, for however long and write about that stuff, because I agree, I find it fascinating. And honestly, like my first econ class I ever took like really shifted how I viewed like a lot of tech. I just kind of blew my mind.
It's one of the first things that I think about, like when I see, different news sources, they'll talk about like what's going on in the stock market today. And almost always they bubble it up to like this one super neat single sentence. They're like, oh, the market is down because of blank. And sure, sometimes it is that clean. But, once you take a couple of those courses and you talk to people like this, you realize just like how interconnected all of this stuff is, which is pretty insane, man. I find it interesting talking to economists that trade, because I don't find many of them. Most of them are kind of a little disenfranchised. They'll invest, but they, at least most that I know, don't actively trade.
Yeah, no, I feel that too. I think because I think most of them are like smart enough to like look at all these things and realize how quickly like things change, and the market's interpreting all this data one day and different data the next day, to where they're like, to hell with all of that nonsense. I'm just going to invest in the good companies over time, whatever. So, Eric, what have you been trading? What have you been, you still been rocking your spreads, your options?
Yeah, dude. So still mostly derivatives. I was cleaning up the portfolio end of last year. So closing out longer term trades that came in nicely, and then mostly reestablishing now for the new year. So I have a bunch of base positions out primarily in the Russell. I trade the Russell a lot. So a lot of short puts in IWM right now across different expirations. And then I have some individual positions on in things like Pfizer, Tesla, Amazon, just typical base positions. I'm maintaining pretty light utilization. Dude, the market this year so far has been fascinating to me. Just as you were saying to that dude, to Aaron, that I couldn't agree more with. I've been really surprised with a lot of the market resilience so far, but I definitely don't feel the same way I did last year. Last year, I was pretty lightly invested for like the first half of the year. I'm definitely using more capital than that, but I'm still keeping a lot of powder dry leading into the second half of the year.
Yeah, I mean, I think honestly the next couple months will be a big, because if the SPY keeps moving in here, I've got the SPY daily chart pulled up right here. Mm-hmm. If like we're able to like, and these next couple weeks will be big with earnings. Like if we dip back below down like toward here and then bounce back, like that's like one thing. If we make new lows, that'll be very concerning. But if we keep making higher lows and keep moving higher, like basically the further away we get from this low of like 350, the less likely I think it is we're heading back down there.
I think it's a fair assessment. I think there's a couple things that I still think we're early, if anything, early stage one chart. Like we need some pretty decent sideways basing before I would trust anything that's happening here. But I
Okay.
mean, anytime you zoom out, 2-3 years, we're still in a downtrend. And I do think it's important for people to remember that, because for anybody that just bought and held last year, they wound up down near 20%. So even though this year's up slightly, it's still in the context of a broader downtrend. So if I wanted to get long most products, I'm waiting until I see some semblance of strength is pretty much all I want. Yeah, dude, there's Netflix. Netflix got slaughtered. Netflix, this has been an interesting follow. Have you been following their earnings over the last few cycles?
Yeah, I mean, of course, you had the few consecutive earnings reports in a row last year that just absolutely crushed the stock.
Yeah.
This earnings report, I haven't really delved fully into. We talked a lot about it on the show yesterday, and I was expecting the report to not be great. Yeah, I was expecting it to be poor and ended up coming in pretty decent. I don't think it was like amazing, but I think it was just better than expectations, which is what mattered.
Exactly. And I think that they actually did a really effective job. You'll notice companies do this where if they know earnings are going to be soft, if they're smart about it, again, depending on the broader context, they're smarter than I am, not to sound like I know the right way to do it. But what I've noticed is they definitely will give you a preamble. And I was actually checking out some of the interim conference calls and interviews with Netflix leading into this earnings event. So I think pretty much anything outside of just a catastrophic meltdown, I don't think the market received it too awfully. And like you said, I mean, they were estimated at 46 cents and they came in at 12. So overall, like still gigantic miss, but nonetheless, against the broader context, not too bad. Earnings so far has been really interesting. For the volatility traders out there, for my options people, that's been a great play. So like trading PPI was really clean with volatility. Same thing with earnings so far. We're not seeing the same overall insane moves that we were seeing in 2020 and 2021, which I think is an important note for people that trade earnings or volatility and they got scared out of it because they probably got their hand shook a few times because it was an overall turbulent time. We were seeing way more edge cases than usual, but earnings so far this year has been very tradable.
Yeah, and I think, again, like I said, I think this earnings season will just prove to be pretty pivotal because I think I think one of two things are going to happen, right? I think you're going to see companies report not so great earnings and give some scary guidance, and we're going to see that across the board and like the big names kind of get crushed. Or we're going to see what we saw with Netflix, where companies might report kind of like mixed to not so great earnings, but the stock's trading higher. And if across the board stocks are like trading well or trading higher after not so great earnings reports, I'm going to see that as a pretty bullish sign. And vice versa, if a company like beats or whatever and the stock's trading down, I'll see that as a pretty bearish sign.
Yeah, I think that's fair. And I think one of the other things I noticed during the previous earnings cycle was the forecasts. Almost all of the big tech companies specifically were very soft in their forecasts. So that immediately starts to get priced in post that initial earnings release from the previous quarter. So to your point, provided that we don't see anything super outlandish, it typically looks okay. But I mean, like even Netflix is starting to catch a bid. Like on a 6-month chart, it's linear regression channels are upward sloping, which is always important to me. The moving averages are all structured the way I would want them to, short term over midterm over long term. So it's interesting to see Netflix doing its thing here. But I mean, as I was looking at volatility leading into earnings, we had implied volatility for the options traders was marked at 64% and historic was 43%. Big volatility edges there. So those are really tradable events. And I mean, last year I didn't trade them too much, but this year I've been pretty heavily involved in earnings and intend to remain so at least for the first quarter.
Hell yeah, I love that. Well, Eric, unfortunately we're kind of running up on time here.
Yeah, dude, totally cool.
1 p.m. But if you want to give us just kind of a quick rapid fire of like, maybe stocks you've been trading or trades you like, I don't know. We got a few more minutes.
Yeah, no. I'm cool. I was actually really enjoying that previous conversation anyways. I think the main stuff I'm looking at is next week we have really getting into the heart of earnings, in my opinion, as I typically would frame it. We're getting through most of the financials already. We have all of that information synthesized. Goldman Sachs, I think, is a great canary in the coal mine. So if you haven't looked at Goldman Sachs earnings, their report itself, I encourage you to do so, because that's one of my favorite earnings reports to look at, because Goldman Sachs it has a lot of eminence, not just in the financial industry, but they also touch a lot of other things. So the way that they frame overall the landscape is typically pretty informative to me. And the previous earnings, I think, has been useful for that. So if you haven't checked that out, I encourage you to do so.
Will do. All right. Well, Eric, always a pleasure to get you on the show. Thanks for hopping on this Friday. It's been too long. I'm going to go ahead and drop your Twitter in the chat at ES Invests. Anywhere else you would like folks to check out more from you?
No, man, that's perfect. And then, I'd love to connect with you again in the future, maybe talk about doing that options playlist of some sort. I think that would be super fun. But yeah, it was great to touch base with you, dude.
Yeah, I know we need to reconvene on that. Kind of got put on the back burner before the end of the year.
Dude.
You know how it is toward the end of the year, all these projects start popping up, but that is something I think our audience would be very much interested in. So, Eric, enjoy the rest of your Friday. Have a great weekend, and we'll chat soon, okay?
Take care, brother.
Peace.
See you guys.
All right, y'all. That was Eric from ES Invest. Go ahead and give him a follow on Twitter. All righty, it is 1:03 p.m. No stock market movers today, but I believe they will be back for pre-market prep at the close. Other than that, we'll be back on Monday. That's next week. Next week might be a tough week for me. Maybe, I don't know, just in terms of it being like a full week, because this week is honestly, all right, it was really weird. So we were off on Monday, right, for Martin Luther King Day. Tuesday came into work. Felt like a Monday because it was the first day of the week, right? But then for some reason, Wednesday, which probably should have felt like my Tuesday, felt like a Thursday. And then I thought yesterday was Friday. So for some reason, somehow this 4-day week has felt very long. So I'm anticipating next week, the 5-day week, to feel like a month. So I don't know. We'll figure it out. That's a future Aaron problem. But alrighty, y'all. Hope everyone has a great weekend. We'll be back on Monday. Till then, stay happy, stay green. Smash the like if you have not already. That's an order from Aaron Thomas. He said, you have to hit the like.